Hello, everybody, and welcome to the Spring 2022 edition of Close the Deal. After eight weeks of preparation, we finally made it. First of all, I want to thank you all for attending. I know it might be difficult given it's Ramadan and we have such a diverse group of people from all over the world, five, six continents, Africa, America, Europe, Asia, absolutely everywhere. As well, I want to congratulate the finalists to have made it this year. This has been by far the most competitive semester in Close the Deal history. I know selecting the six finalists that we're going to be presenting today was incredibly difficult and incredibly close out of the few dozens of presentations that we received this year. And I want to thank you all for your participation and thank you all for the effort that you've given us over the last 8 weeks. We are so grateful and so appreciative. So yeah, I can't wait to see some of these pitches. So before we start, I just want to go over quickly an overview of the competition and what was expected from the students. So Close the Deal M&A competition is a mergers and acquisitions competition where we have students come up with a optimal mergers and acquisition deal recommendation. Ideally, we want them to have a somewhat feasible and realistic deal with smaller private companies. However, this is not the case for all of the pitches. Within each of the pitches, we recommended for all of them to go through two big ideas. First, the industry analysis, whichever industry they decided to go into, whether it be healthcare, whether it be aviation, whether it be the energy sector, to really analyze that sector, and then select targets, their buyers and sellers for the optimal deal for their final recommendation. So each student or each group will receive 8 minutes to present their pitch, followed by 5 minutes of questioning from our jury members that I will present just now. So first, let's go through the judges. First of all, we have Frédéric Manquette. I thank you so much, Frédéric, for being here. If you don't mind just saying hello really quickly.
Sure. Hi, everyone. I'm really pleased to be part of the judges for this competition. I look forward to seeing and hearing from all of you about your proposed M&A recommendation. Best of luck and thanks for having me.
Perfect. So Frédéric is, thank you for that. He is a current investment analyst for the International Finance Corporation working in infrastructure and natural resources. He has about 10 years of experience in the industry working in oil and gas M&A for ENOC, previously, as well as emerging markets M&A at Ernst & Young, and as well as Alpha Value. Our next judge will be Daniel Shaw. So Daniel is currently the managing director for Valenta with about 15 years experience in investment banking, working for Standard Chartered, HSBC, Barclays Investment Bank, and also the FNZ Group with FIG, specializing in fintech. So thank you so much, Daniel, for joining us. And then finally, we have Saad Benani, who will be joining us a little bit later in this presentation. He's currently managing director of the Middle East North Africa region of Deutsche Bank. He has about 25 to 27 years of experience in investment banking, ranging from his time at Credit Suisse, Deutsche Bank earlier in his career, Merrill Lynch, and Salomon Smith Barney. Before I continue, I also want to go through the presentation order and the judging criteria. So our presentations will start with the McGillian's presentation. Then we will go with Stamford Capital, and I think they're lab-grown diamonds, Pepper, Triple Monster Energy, the Preppers, and then the Wind Energy team. So please, knowing this, please be prepared for when I give it off to my colleague Karan in a second. Next, we'll go over the judging criteria and how all of these presentations are going to be judged by our jury members, and so that we come up with a final result. So first, we have origination, which is the extent to which your M&A recommendation is original, unique, and adds value. Practicalness, the extent to which your optimal deal is achievable and realistic and practical in practice, and its feasibility. The content itself, which is the extent to which your recommendation is backed up by sound research, industry analysis, and the buyer and seller research. The presentation itself, the extent to which the structure of your presentation is made clear, concision, and how the content is displayed in a way for everyone to clearly understand. The delivery, which is the presentation from the students, which is the extent to which you deliver a convincing argument for the jury to cast their ballot for you. And then finally, understanding, which is how you respond to the questions of the jury to really demonstrate that you have a thorough understanding and comprehension of the deal recommendation you have. So without further ado, I will pass it on to my colleague Karan for presentation time. Again, like I said, again, thank you all for joining us, and I look forward to seeing these presentations. Thank you.
Thanks very much for that, Jalil. Great introduction. And hello, everybody. It's great to be with you guys again for this semester. So without further ado, I'd like to call up the team McGillians for their presentation. All you guys, whoever wants to start sharing their screen, all the best. And also, just to remind you, we have 8 minutes for the actual presentation and 5 minutes for questions from the judges at the end. I will send you a warning on the chat when there's 1 minute left of your time. So thanks very much. All the best.
Hey, Karan. Sorry, the share screen is not authorized.
Oh, okay. Cameron, will you be able to fix that? Because he has the power in that regard.
Yeah, you should be able to share now, Ariel.
Okay, great. Take it away, guys.
Okay, hi everyone. It's a pleasure to be here. It's a pleasure to have been selected as a finalist. I'd like to thank Focus Finance for having organized this competition, as well as the judges for being here. My name is Adil Amlaiki from McGill University, and I'm joined by my colleagues, Nicola Tudeliers, Anishu Masuthin, Karen Zwang, and Juan Batiz. And today we're going to propose a unique deal where Bridgepoint, the private equity firm, would acquire Travelex in hopes of performing a peer roll-up and merging it with its portfolio company, Moneycorp. So our discounted multiples estimation yielded a figure of 20.74 times. Our DCF valuation had a value of 1.74 billion, and our IR analysis yielded a figure of 19.4%. Our investment theses are simple. We're going to look at the competitive positioning of the combined entity, the cost and revenue synergies, undervaluation, as well as the strategic alignment. So in terms of the company overviews, we're going to look at Travelex. So Travelex is a private foreign exchange company headquartered in London. Due to the COVID-19 pandemic, in combination with other complications, Travelex completed a restructuring of its business in August of 2020. So over here, we also see the new ownership structure with Barings and Vector Capital, so private firms. The leadership has significant investment banking experience, and corporate finance transactions include a division sold to MasterCard and Western Union, which have done very well. And in 2014, businessman B.R. Shetty acquired Travelex and then placed it in a holding company called Finabler that's based in the UAE. In terms of Bridgepoint, it's a private equity firm with 30 billion euros in assets under management. It has so relevant portfolio companies include Moneycorp, which we're going to talk about, FCG and Fenergo, which are also in the financial services industry. I'll pass it on to Anish.
Thanks, Adil. So shedding a little bit more light on Moneycorp. Moneycorp is a British firm founded in 1962, whose main revenues come largely from buying and selling different currencies with a more attractive banks. They have a huge geographic presence with office locations in countries like Romania, Canada, and the United States. And they've also undertaken a number of different corporate finance transactions, including owning now a 90% stake in Brazilian currency company Novo Mundo. I'll pass it off to Karen to go through our industry overview.
Perfect. Thank you, Anish. So let's dive right into the industry overview. If we go into the next slide, the industry consists primarily of operators that offer B2B payment services. They provide debt and credit card processing services, and they also provide currency exchange services. Now, moving on to the next slide, we'll see that there are some key trends that we wanted to highlight for you in this industry. The first is that there is strong and growing external competition. The second is that there are an increase in inbound trips to the US due to the lifting of pandemic restrictions in 2022, as well as international trips taken by US residents are also expected to increase. And finally, consumer access to credit also is expected to increase, and this all kind of promotes a future outlook for this industry. Now, in terms of the target consumer segments, we split it up based on businesses as well as individuals. So they work business to business, but there's also individuals in this industry, and we've split them up based on their different age demographics. And this is mostly due to the fact that at different points in your life, you have different spending habits. So moving on to our competitive environment, we've segmented based on international payments, foreign currency exchange, and prepaid credit cards. And this is something we'll explore in a little bit more detail later on in the presentation. So I'll pass it off to Juan.
Thanks, Karen. So our first investment thesis stems from the combined entity's competitive position. We know that Travelex has a very strong physical retail presence in some of the busiest airports around the world, but lacks the cybersecurity needs to keep their clients' data safe, which threatens the sustainability of its online distribution channel and market-leading position. On the other hand, Moneycorp has an extremely robust online retailing presence and places a strong emphasis on cybersecurity. As a result, it's well positioned to expand and take advantage of valuable regions in the FX services industry like Latin America and Asia, while staying competitive in a technologically changing landscape. The combined entity resulting from a merger between Travelex and Moneycorp will be one that leverages each company's strengths and opportunities to overcome their respective threats and weaknesses, resulting in an FX service provider with a strong brick and mortar and online presence, and that has an emphasis on cybersecurity, opportunities to expand globally, and the resources to successfully tackle its constantly changing environment.
Thank you, Juan. So looking at the cost and revenue synergies, we have a previous deal that occurred with Travelex merger, 2015 merger with UAE Exchange, with the goal of publicly listing the company in 2017. And here the goal was to create a much larger customer base, as well as carrying out an IPO for the combined entity. The limitations are that both companies operate in different jurisdictions, but we wouldn't have this problem with Moneycorp. And so it would result in cost and revenue synergies. And here we've actually calculated the combined entity market share for the combined company, and we've found a 12.64% figure. And based on the UAE Exchange and Travelex merger, we believe this can go up to 16%, which would make it the biggest company in the Forex market. So in terms of undervaluation, our undervaluation thesis, there were 4 isolated events that occurred all of it at the same time, and that hindered the financial condition of the company, but not its operations. So its operations remained intact, whereas its financial state was heavily impacted. So one, Finabler, the holding company, announced more debt than it had reported, from 300 million to 1.3 billion. COVID-19 pandemic caused offices to close for more than 8 weeks, with 25 million loss in first quarter and 1,300 lost jobs. There was a cyber attack. Travelex's apps and websites were taken offline after a cyber attack, and they had to pay 2.3 million in ransom in Bitcoin. And here is a timeline of the things that happened. So really, the operations are intact, but the financial condition of all of these events happening at the same time made it so the company is undervalued. Moving on to strategic alignment.
Beautiful. So how exactly does this transaction fit into Bridgepoint Capital strategy? Essentially, we know that the company deals with other firms that capitalize between 250 million to 1.5 billion euros, and they have a sector focus in the financial services. Thus, we can conclude that Travelex fits perfectly into Bridgepoint's middle market strategy and their preference for companies that are not only in high growth industries, but also have high growth potential as well. Now I'll move over to the valuation.
Thanks, Anish. Yeah, so reflective of our competitive analysis, we split Travelex's business segments into its 3 main service lines and identified relevant competitors within each to derive a comparable multiple. We also applied a 10% discount to account for the fact that Travelex is a private entity, yielding an EV to EBITDA of 20.7. Now, moving on to our LBO model, We forecasted the company's unlevered free cash flow over an investment horizon of 7 years and used our comparables analysis to derive an enterprise value of 2.9 million pounds. To finance this acquisition, we modeled 4 debt tranches amounting to 2.5 billion pounds, leaving the equity sponsor with a required investment of 450 million. Now, finally, we analyzed the implied IRR for Bridgepoint, which amounted to 19.1% with our current leverage assumptions. This accounts for 200 million pound in minimum cash balance covenants. It should also be noted that our model shows a fairly high net debt to EBITDA. However, as we just mentioned, we believe that the value behind this deal goes beyond the simple financial impact and is more synergetic in value. So this concludes our presentation. We'll now open up the floor to questions.
Great, thank you guys. So questions, judges, please go ahead. You have 5 minutes time.
Hi, everyone. Thank you. Thanks a lot for this presentation. Very interesting. This is Frederick speaking, by the way. So I just want to come back to one important slide that you mentioned, where you mentioned revenue and cost synergies. Yes, no, it was the next one actually. The next slide, I think. No, the previous one, yeah, sorry, that, yes. So how do you see these synergies materializing, and how do you, and why would, what would indicate to you that Travelex shareholders are considering to sell? Because if we assume that synergy can be derived from this acquisition, it might be also the strategy from Travelex management or shareholders. So I just want to understand if you thought a little bit about how these synergies can be materialized a little bit more, and if you also thought about how a potential acquisition would be received from Travelex shareholders.
Thank you for your question. I think that's a fantastic question. So I'd like to answer your question in 2-point form. First of all, we've looked at a previous deal with Travelex and UAE Exchange, and the idea here is that there were some limitations here with the cultures being different and the countries operating in different jurisdictions. So looking at the previous synergies that occurred with that deal, we believe that the synergies from Moneycorp and Travelex would be even greater and more likely to materialize, even given the fact that they have materialized with the previous or comparable deal. In response to your second question for stakeholders, I'd like to mention that all of these isolated events that we mentioned earlier really affected the financial condition of Travelex, and the fact that it would be backed by a private equity firm, as well as of the fact that synergies would occur between the two firms, would make the shareholders very likely to authorize the deal.
Okay. Okay. No, great answer. Okay. And so it was. I know the presentation are quite fast, but if I remember correctly, in terms of the debt of the company right now, it's if I saw it right, it's quite high, right? So
for now, the company is fairly levered, indeed.
Mm-hmm.
If I had to pull the models from the model, just give me 1 second.
No, just don't worry. I'm just trying to bring up a point here. Is
Sure.
If there is a high leverage with this company, it means that basically any acquisitions anyone who would acquire the company would take on that debt and carry it forward or pay down, and decide is the leverage structure of the company going forward. Mm-hmm. And this means that basically, if as an investor looking at a pure LBO valuation, is it might not be the best way to look at it, given the existing high leverage of the company. So in your view, do you think, based on your analysis, what was the best, based on what valuation methodology would you recommend to use to put a price on this company?
Sure. It's very tricky because Travelex is obviously in a fairly niche market when it comes to its core operations. There are not a lot of foreign exchange companies out there that do exactly the same as Travelex, as we mentioned earlier. So we try to split our comparables analysis into its different segments and try and do in sort of weighted average, as you can see here, to derive, let's say, a multiple that makes sense for Travelex as a whole. Now, when it comes to our valuation of the LBO, Travelex has had financial trouble in the past, as we mentioned before. And so I don't think the net income, or at least its past financial performance, is really reflective of its true financial potential going forward, especially if we price in the fact that it's going to be merged in a roll-up with Moneycorp. So it's a very tricky company to value. So that's why we focused a bit on IRR and to try and model these debt tranches on it, which amount to £2.5 billion so far. But to be honest, it's a very tricky company to value, as you pointed out, obviously, yeah.
But, sorry to interject, and I'll speak a little bit later. Why is Travelex tricky to value it? It's a listed company. Listed companies are valued by the market.
I do not think it's listed at the moment.
It is listed. The ticker is Enabler.
Oh, yeah. In that sense, yeah. Absolutely.
I mean, I did the IPO, so I know Travelex really well.
Right. Yeah. That is a good point that you mentioned. Yeah, absolutely.
And Moneycorp, who owns Moneycorp?
Moneycorp is currently owned by Bridgepoint, the private equity firm. That's the reasoning behind the deal.
Yeah, and Bridgepoint bought Moneycorp when?
That's a good question. Adil, you probably have that information.
I'll tell you, it was about 2 years ago. They bought from Corsair Capital. A lot of debt in Bridgepoint, as you said, which I completely agree with. But Moneycorp is a smaller group than Travelex. I like the idea. It's going to be a bigger than a merger of equals, which is what would make it tricky. The other thing is Travelex. One thing that you said was that Travelex has had financial trouble in the past. Travelex per se hasn't had financial trouble in the past. Its sister group, UAE Exchange, has had lots of trouble, and a lot of that had to do with things to do with fraud and from its owner, BRS SETI. But the Travelex group team, which is headed by Tony Fernandez, has been completely fine.
Sorry, guys, gonna have to interject there. We're a bit over our 5-minute line for questions, but thanks so much. That was great dialogue and great job, Team McGillions.
Thank you. Thanks so much.
So, yeah, for sure. So now we'll move on to Team Stamford Capital. If someone would like to share their screen. Great. All the best, guys.
Oh, hi. Can I just check if you guys can hear us?
Yep, all good on my end.
All right, great. Okay. A very good day to all. We are Stamford Capital from Singapore, and we'll be taking you through a potential acquisition in the lab-grown diamond industry. In determining the industry to focus on, we looked at general trends to identify potential opportunities that we believe could be exploited. Our search led us to the luxury market in the US, which was projected to grow due to the forecasted rise in US GDP. Upon digging deeper, we recognized a huge divergence between the demand and supply for diamonds. While demand is projected to grow due to changing fashion trends and rising affluence, present and future supply shortages mean that the growing appetite for diamonds will be left unsatisfied, and this divergence poses a question to the industry. Our answer to this question comes in the form of lab-grown diamonds. Compared to mined diamonds, synthetic diamonds are 50 to 70% cheaper to produce, are more sustainable to produce, and the best part is that they look just the same. Compared to regular diamonds, the production of synthetic diamonds consume way less resources and are way safer to produce. This has led us to believe that synthetic diamonds can plug the gaping hole in the market.
To summarize, from demand and supply side, there is a supply scarcity of mined diamonds by an overall increase in demand for diamonds. On the other hand, lab-grown diamonds generate lower costs and they are more affordable. From sustainability perspective, lab-grown diamonds are generally more environmentally friendly and ethical in the production. As such, lab-grown diamonds can be deemed as an increasingly strong substitute of mined diamonds. Next. Some potential weaknesses and threats of lab-grown diamonds are highlighted in our SWOT analysis, such as the fundamentally differences from mined diamonds, the heavy dependence of demand on the consumer's taste and preferences, and the competitiveness in the industry. Next. Based on our macro industry analysis, we shortlisted 2 potential sellers. Next. First is Brilliant Earth Group, a major player in the wedding ring industry. It has a high adaptivity to the market trends and a strong focus on ESG factors. Its revenues is expected to increase continuously until 2024 with positive annual EBITDA. Next. The second potential seller is Charles & Colvard. It manufactures and markets lab-grown diamonds and moissanite jewels under their 2 brands with a strong direct-to-consumer presence. Its business model differentiates their products, and there is also an overall increase in 5-year annual revenue and EBITDA.
Now we'll be moving on to our potential buyers. Next. So we have shortlisted a list of strategic and financial buyers using key metrics like business segments and geographical regions. We have chosen to focus on mainly strategic buyers so that we can have apple-to-apple analysis on mainly Signet and CFA. Next. So CFA is a Swiss company that has global operations in many product lines. You might know it for subsidiaries like Cartier and Net-a-Porter, and its 5-year revenue and EBITDA have been holding steady over the years. Next. Signet is also a large contending buyer, but the key thing is that it's largely concentrated in North America and the UK. However, its revenue and EBITDA have been seeing a steady decline over the past few years. Next. Before we explain the rationale for our optimal deal, next. Here are some key considerations in industry analysis, criteria in shortlisting, and choosing sellers and buyers. For industry analysis, our key consideration was ESG, which we believe is pertinent to the diamond industry due to diamonds historically having human and environmental exploitation. For shortlisting criteria, we decided to focus on things like characteristics of good potential buyers and sellers, such as growth potential. In selecting our optimal companies, we focus on synergies, uniqueness, and also which buyers are more likely to buy and which more likely to sell. Now I'll be passing my time on to Iran.
When considering the choice of target, we assess the growth opportunities through 2 key components made of historical growth rates and strong business fundamentals. For the past 3 years, the average year-on-year growth rates for Charles & Colvard's 13.6% is dwarfed by Brilliant Earth's 42%, where the company has historically shown that they are growing at a rapid rate. Brilliant Earth's growth strategy is buoyed by strong guiding principles, where the company focuses on sustainable and ethical growth. 2 key strategies they employ are blockchain-enabled diamonds, which allows for greater transparency behind the source of the diamond, whether lab-grown or ethically mined. The second key strategy is offering diamonds beyond conflict-free, which ensures that they do not finance rebel movements, offer protection against human rights abuse, and minimize environmental degradations. Coupled with Brilliant Earth's intention to expand into the European and Asian market, the deal team is certain that Brilliant Earth is the perfect fit for a growth acquisition. Next. In determining the choice of acquirers, we have shortlisted down to 2 strategic acquirers, Richemont and Signet Jewelers. Our rationale for choice is backed by 3 reasons. Given Richemont's strong financials, credit rating, and global presence, Richemont is more capable of raising funds through the equity, debt, and loan capital markets. Richemont's global presence and strong brand recognitions will aid Brilliant Earth in scaling up production and eventually penetrating the above markets. Lastly, strong overlaps within Signet and Brilliant Earth's business and geographic segment allow them to operate more as competitors instead of business partners. Moving on, I'll be sharing about the potential synergies between Richemont and Brilliant Earth. for Brilliant Earth, we potentially see cost savings. And for Richmond, we see a further stretching of product lines towards a more affordable and sustainable product lines, which attract a new untapped demographic and protects their current customer base. On both sides, we can potentially see sharing of technical and industrial know-hows, which can build upon upcoming products. The deal is proposed to be 100% funded by cash, given the precedent acquisitions of Richmond has been fully funded by cash. Taking into account Richmond's cash on hand, it will approximately only account for 2.4 to 3% of their total cash balances.
Currently, Brilliant Earth is trading at a lower range for the EV over revenue and EV over EBITDA multiples, whereas the PB and PE multiple side is trading on the higher end. So given BE's robust revenue growth for the past year, coupled with the reopening of the economy, our team foresees large improvement in its enterprise value multiples. Additionally, the market is valuing BE as a company with huge potential for growth, with its PB trading at 12.5x. Next. So these are the respective enterprise values calculated using the Gordon growth and exit multiples method. Next. Moving to our discount rate inputs, we got a risk-free rate of 2.44% from the US 10-year Treasury yield, equity risk premium of 4.24% from Damodaran's website, country risk premium to be 0. And for beta, we got 1.99 by regressing it against the S&P 500 returns. Hence, using a CAPM formula, we got a cost of equity to be 10.9%. Using an after-tax cost of debt of 9.2% and DE ratio of 7.57, we derive a weighted average cost of capital of 9.4%. Next. So this is how we computed the beta by regressing the returns of Brilliant Earth against the S&P 500 returns, and we computed beta to be 1.99. Next. So we believe that its total volume will continue to grow on the back of the opening of the economy, which could spur larger consumption. As for cost margins, given that Brilliant Earth is relatively young, we opine that costs will largely remain constant as a percentage of revenue. Next. Lastly, to sense check our valuations, we did a sensitivity analysis on WACC, terminal growth, price over earnings, and net income, and computed a fair value which ranges from 10.55 to 47.22. Thank you for listening to our pitch, and we'll now open the floor for Q&A.
Great, right on time. Judges, please take it away. Great job, guys.
Thank you.
If nobody else goes first, I'll go first. Why do you think it's relevant here when you talk about kind of the environmental impact and the ethical impact of mining diamonds versus synthetic diamonds? As in, why is that relevant at all? Isn't it a different market altogether? Is basically my question.
Maybe I could take a chance to answer that question. Thank you for posing your question. Personally, our team believes that in comparing synthetic and mined diamonds, synthetic diamonds are generally replacing existing customer preferences, as we have seen from several reports, let's say from the consulting companies like McKinsey and Bain. So we have been seeing that, especially for the younger generations with rising incomes, we have seen them starting to pivot towards these kind of synthetic diamonds that are generally fundamentally conflict-free, and also they are removed from the whole idea of blood diamonds because they are not associated with people being, let's say beaten, assaulted, or killed in this kind of mining operations. So we tend to see that this is where the industry is generally going in the long run. And we believe that by CFA acquiring Brilliant Earth, it seeks to extend its product line to cater more to these changing preferences of its current consumer segments and also potentially new customers as well. I hope that answers your question.
I mean, sort of, but there's not a real shortage of diamonds in the world, right? There's way too many naturally occurring diamonds. And the biggest reason for people buying diamonds is basically for engagement rings. And nobody wants to get engaged and get a synthetic diamond, at least as far as I'm aware. But anyway, that did answer or provide an answer so far as an answer is concerned. On one of the slides, you used market cap to EV. Why is that relevant? Why have you used market cap to EV? Not here. It was on one of the
above. Mm.
Yeah, right.
Here. Iran, will you be able to?
Thank you for a question. So I think what our group, now that you've asked this question, we sort of took a step back and think that maybe market cap over EV might not be a good reflection, and we should have just used either market cap or enterprise value. Yeah.
Okay.
Thank you for the question.
That's fine. And then when it comes to potential acquirers, I mean, I guess you're looking at it the other way around. You're looking at a seller, looking at acquirers. Is your choice of acquirer simply based on when you chose Richmond, was it just based on the credit rating? And that's what I understood.
I think from the product line of, thank you for the question. Maybe from a product line's point of view, we saw that, you know, Richmond is dabbling currently in the jewelry market, Cartier and Van Cleef, and these products usually they are definitely in the upper segment in the jewelry market where they are considered as extreme luxury goods. But what we thought of as this was probably as stretching their current product line where they could market to more affordable consumers in the future. And also, as Rachel mentioned before, it's the pivot towards a more sustainable approach as we see more consumers getting more and more interested in lab-grown diamonds instead of naturally mined diamonds. So we see this as an opportunity for Richmond to tap into this relatively new market, which they have not tapped into before their peers, let's say LVMH steps in.
Okay, but when you think about it, you think about it this as a separate business line, which would be a more affordable, separate from their current business, rather than any integration or any synergies, benefits, and anything like that.
Well, synergies, I could definitely see a boost in branding, definitely for Brilliant Earth due to the recognition by Richmond. And perhaps we believe that synergies such as marketing expenses could also decrease for Brilliant Earth on the side of expenses, as well as supplier side decrease for procurement costs for Brilliant Earth too, due to the fact that Richmond probably has a large array of suppliers that caters to them.
Yeah, just to add on, Richmond's revenue growth has been declining over the past years. So this acquisition of a relatively young company which is growing quite well for the past year would in turn boost cost like some sort of revenue synergies. So it could boost their top line growth. Yeah.
Okay.
Hi guys, sorry to interject, but we're very ahead of our 5 minutes. So sorry to interrupt you, Danielle.
That's fine.
And Frederic as well, sorry you didn't have any time to give your thoughts, but how about you start the questions in the next time, if that's okay.
That's
so
fine,
great
that's
job,
fine,
Team
thank you.
Stanford. Yeah, sure. Great job, Team Stanford. I'd like to give it to Team Pepper now. All the best.
Thank you.
Hi guys. Can you hear me?
Yeah.
Yeah, okay.
Good afternoon, everyone. We are Peppers from Adam Smith Business School, University of Glasgow. I'm Ray.
I'm Jin. Hi, I'm Jia.
Today, we have 5 parts: healthcare and digital health industry analysis, potential sellers and buyers, the possible deals, and optimal deal. Let's start from industry analysis. Why we select healthcare? Because healthcare is one of the largest and fastest growing industry in the world. And why we choose US market? Because it's massive. US spent the greatest in the world, accounting 20% of the GDP in 2020. There are some trends of health during COVID-19, a new way of working, needs of low costs, needs of increased treatment efficiency. They will definitely push a digital revolution. And also, there are some factors fueling the digital transformation, like lower cost, is easy to access, help patients more effectively. The market size of digital health is forecasted to grow both globally and US. Global M&A has decreased significantly due to coronavirus, but the deals in digital health industry increased. And this is also why we choose the digital health industry in US. Of course, there are some benefits. The benefits is lower cost for business and patients, and avoiding virus transformation under pandemic, but it also comes with concern about personal data and privacy, something like that. Okay, let's move on to the next part. Thank you.
Yeah. Next are potential sellers and buyers. We conducted the financial analysis and use the DCF method for valuation. For the potential sellers, all of them are digital health companies. First, the Champions Oncology. It offers service to help drug development. In the last 5 years, it had high quality earnings and operational efficiency. Its earnings are expected to increase significantly. The main motive for MA is to expand into the new market. Second, Simulation Plus. It creates software for drug development modeling. They also have high quality earnings. Its earnings are expected to grow faster than the industry over the next 3 years. But due to the increased short-term investment, the ROE and ROA decreased in 2020. Their main motive is to achieve diversification. Third, Optimize Rex. It provides digital health technology to accelerate patient access to treatment. Earnings are expected to grow 78% over the next 3 years, and it has sufficient liquidity and solvency. Their primary goal in MA is to reduce competition and achieve a monopoly. We also have 3 buyers. First, the Nectar Therapeutics. It provides therapies and clinical trials for cancer treatment. This company is currently unprofitable due to the high cost of R&D, and earnings and revenues are expected to grow faster. The primary goal of MA is to acquire the new technology in order to accelerate the R&D and reduce costs. Second, Arrowhead. It develops medicines to treat the different disease. However, it's unprofitable because of the high R&D cost in the past 5 years. Revenue is expected to grow by 31% in the next 3 years. The main motive for the MA deals is also to acquire the new technologies and turn to profit in the future. Third, CareCloud. It provides healthcare software. Profitability increased in the past 5 years and also enhanced its operational efficiency. It's forecasted that they will have a 44% growth in earnings. Their main motive for MA is to achieve a monopoly by decreasing competition. Okay, let's move on to the next part.
Okay, so we have 3 possible deals. The first one is a vertical deal between 2 companies. The first is a digital health company. It develops technology solutions and products for drugs and care, Champion Oncology. And the second is a biopharmaceutical company focuses on developing medicines, Nectar Therapeutics. The diversification of products and services in the cancer treatment field can be achieved by this deal. And it also comes with some potential risks like tax risk, cyber risk, and integration shortfalls. And the second possible deal is similar to the first one. It's also a vertical deal between a digital health company, Simulations Plus, focusing on drug discovery and development software, and a medicine developing company, Arrowhead Pharmaceuticals. And it also comes with some risks like cyber risk, tax risk, and handoff risk. And the third possible deal is a horizontal deal between 2 digital health technology companies, OptimalRx and CareCloud. this kind of deal creates economics of scale. It also comes with some risks like culture clash, integration shortfalls, and intellectual property risk. So for the optimal deal, we chose Simulation Plus and Arrowhead Pharmaceuticals. So why we chose this deal? Because some financial analysts bearish Arrowhead because the clinical process is too long. And it seems like the market doesn't have much forbearance on the pre-commercial process of the drug development process. So by acquiring a drug discovery and development software can using modeling and simulation models, the company can achieve two types of synergies. The first is cost synergies, the reducing research and development costs and the cost of clinical trials by using software simulation. And the second is operating synergies, improve operational efficiency and shorten the process of developing new medicines, thus boosting revenue and increase market share. So you may have a question why the deal is possible. According to the figure below, you can see the free cash flow is not enough to cover the deal by purchasing assets for the buyer company, Arrowhead. And so we suggest the payment by transferring shares equivalent to the valuation. And for corporate governance perspective, the vision, the two companies both want to short the process of drug development and testing can benefit the patients. And for the employee perspective, simulations just have 141 employees. Employee resettlement fees would be low. And all in all, digital health is a new trend and under COVID-19. And Simulations Plus have 12 software, 3 main fields of services. Acquiring a digital company is a way for Arrowhead to beat the competitors and get out of financial trouble. That's all. Thank you. If you have any questions, please feel free to ask.
Thank you.
Thank you.
Thank you very much, guys. Great job. Frederic, if you'd like to start with the questions this time, please.
Yeah, sure. Thank you. Thank you very much. Very interesting recommendation. In terms of, so the way you presented the potential buyers, I feel was interesting because in general, when you present potential buyers, you want to show strong buyers. And some of them, I think for 2 of them, you mentioned that they were in either financial trouble or having financial difficulties. So I just wanted to understand why made you think that I think these 2 out of 3 companies were potential buyers for your targeted companies.
Yeah, that is a good question. Thank you. So these 3 companies, they have a relatively bigger market share, and the market capital is relatively high. So we know that they are bigger companies than the sellers. And if you can see in this slide, the total annual revenue is bigger than the sellers, and the market capital is like billion. But they are currently in financial struggle is because of the COVID-19 pandemic. And they develop drugs and the process is a little bit long. So the clinical trial is long. That's the reason why they need to acquire the technology companies, digital health companies to improve the process, as I have mentioned in the final part. Yeah, I hope that answers your question.
Yes, absolutely. Thank you. And just to come, sorry, I think someone wanted to speak. Okay. Yes. So thank you. And just to go back to your recommendation for the deal, I think the very last slide was mentioning you had an explanation about how to proceed with the acquisition, which is basically the exchange of shares. And you mentioned FCFF of 118 million and total assets of 180 million. So can you just explain a little bit your thoughts on and your process in terms of the acquisition strategy for the acquisition price?
Yes, we do the valuation through the DCF method. You can see the firstly we forecast the discount rate and like the cost of equity and WCC. The cost of equity we find some data from the Bloomberg and the U.S. market trader yield, and we also forecast several items in their financial statement, such as the revenue, net income, and depreciation, amortization. Please next slides. So this is our result of our valuation. We forecast firstly, from the previous years, their financial result, we forecasted their revenue, net income, some key items in the FCFF and the FCFE. And secondly, we calculated the terminal goods rate and their PV of FCF and PV of FCE, so that we have the result of equity value. This is the same result, the same calculation process is like the Arrowhead company. Thank you.
Frederick, do you mind if I ask a question?
Yes, please go ahead.
On the same slide, and exactly what Frederick referred to, you said they do not have sufficient, or the acquirer does not have sufficient FCFE or FCF, and to keep it general. Therefore, you recommend that there is an exchange of shares. Why would they not consider debt first?
It's also
and sorry,
I'm sorry.
No, and within the same answer, why is the total assets of Simulation Plus relevant at all? Why do you even care what the total assets are?
I'm sorry, can you repeat it? Why do you care about?
So you've shown here total assets of Simulation Plus. Why are total assets relevant at all? Why do I care what the total assets are?
So we can consider different ways to acquire a company. One way is to buy the assets of the company. It means acquire the whole company. And the second, there are other ways by transferring shares, buy shares with shares, exchange shares. And this type of, so we calculate the total assets for, to say if Arrowhead can acquire or buy the Simulation Plus the whole company, but we find out the free cash flow and it's not enough to cover the total asset. So we consider to maybe we can negotiate by transferring shares equivalent to the valuation. Yeah, that's
okay.
it.
So firstly, you cannot acquire ever a company on the basis of its book value for total assets. Nobody sells at book value. It's either higher or lower. This is where the concept of goodwill comes in. Second thing is, my question is still, why not use debt? Why issue shares? Wouldn't that be dilutive to the current shareholders?
So the current shareholders are mostly PE companies and VC companies. So this kind of companies are more likely to engage in share exchanging activities. So that is the reason we chose transferring shares. But maybe we didn't consider enough on this financing method, and we can improve it. Thank you.
Okay, guys, I'll have to interject there. We're over our 5-minute time limit for questions, but thank you. That was some great dialogue.
Thank you.
Sure. Thanks, guys. I'd now like to hand over to Team Triple Monster for their presentation. All the best.
Leung, you want to share your screen?
Oh yeah, can you see the screen?
Yeah.
All right, so today our team is pitching a potential acquisition of Monster Beverage Corporation. We'll be going through our industry analysis, target company, and finally onto the buyer. To start off, the industry that we've chosen is the beverage industry, more specifically in energy drinks. In 2021, global energy drink sales reached $61.4 billion US, and this is expected to grow by 7% compound annual growth rate till 2026. As the COVID-19 pandemic fades, consumer demand for energy drinks are expected to remain elevated as more consumers are returning to the workforce. This means more energy needs for work, travel, and social occasions. The energy drinks market is a competitive market with only a few major players, namely Red Bull, Monster, and Rockstar. Competitors in the market face challenges such as distribution, obtaining shelf space, and offering unique products to differentiate from each other. Hence, expansion of market share is usually done with partnerships, mergers, and acquisitions. Some of the growth drivers for the market include growing demand through e-commerce sales. Companies are also leveraging innovation and introducing products with new exotic flavors or sugar-free and functional energy drinks. For key market trends, companies have pledged to eliminate artificial additives and release non-sugary energy drinks to keep up with shifting consumer demands. For example, Red Bull introducing its Red Bull Zero in 2020, and Monster with its Monster Energy Ultra Gold in 2021.
Moving on to the next section, we selected one seller to be considered in our acquisition deal. The selling company we selected is Monster Beverage Corporation, an American multinational beverage company that manufactures energy drinks, coffee drinks, soft drinks, and alcoholic beverages with 87 years of operating history. The company is selling its beverages in more than 100 countries with 40% of the market share in US energy drink market. Some company highlights. The company achieved record high annual sales in year-end 2021 of $5.22 billion with 20.5% year-to-year growth. Its enterprise value is $36.6 billion and market cap is $40 billion. EV/EBITDA multiple is valued at 17.95 times based on the 2022 estimates. Please take note that all of our valuation were computed on March 15, 2022 at $75.08 per share.
Right, after a thorough research about Monster, we thought that it's undervalued depending on the methodology and the selected year we used. So first of all, its revenue and EBITDA was estimated to have 9.5% and 8.2% year-to-year growth respectively. And we estimated that based on Wall Street analyst estimates. By comparing to 4 companies in similar industries, we decided to use 17% as our selected target capital structure and 1.133 as our levered beta. From our levered beta and selected target capital structure, we then calculated the cost of equity and percentage debt and equity. Then we got our WACC of about 7.4%. And assuming terminal growth rate to be 3%, which is pretty conservative here since the industry compound annual growth rate is about 7%, we calculated our total present value of free cash flow and came up with the implied enterprise value of about $46 billion and implied EBITDA multiple of 21 times, resulting in an implied share price of $91.67. Or we can say that's 22.1% premium of its current share price. And here's the sensitivity analysis. The range of discount rates are based on 7.4% median WACC plus minus 0.2%, with Monster's current capital structure and long-term growth rate about 3% plus minus 0.5%. And we'll pick 9 implied share prices here for our football field analysis later on.
Moving on to the trading comp analysis, we selected 4 beverage companies to be considered in our trading comps analysis based on the similarities in the industry, product mix, geographical reach, growth prospects, and ROIC. Based on the comparable company analysis, we concluded that Monster should be valued between 14 times to 17 times EV next 12-month EBITDA, leading an implied share price range of $41 to $152. And here comes to our third valuation method after DCF and comparable analysis, the precedent transaction analysis. We selected 5 deals from the past to be considered in our precedent transaction analysis, and we come out a range of EV last 12-month EBITDA multiple between 11.9 times to 24.8 times.
We can see that some of the precedent transactions were done a long time ago. Some were done in 1995 based on the Capital IQ's data. And thus we encourage investors to put more weight on the public comparables, EV to next 12-month EBITDA and EV last 12-month EBITDA, and also the DCF analysis, and try to come up with the range of implied share price. So we got about $80 to $100 here. And this is the conclusion we had based on the football field valuation. Like I mentioned, the range of implied share price around $80 to $100, and point estimate 90 is $91.6 or 21.1% premium to its current share price. All right, so next is the key challenges that we think Monster are facing, and that's a reason we think why there's a better deal that could create value to shareholders. The first is the failure to accurately estimate demand for their products. The second is the risk associated with dependence on relationship with the Coca-Cola company, and last but not least, the cost of packaging supplies, ocean domestic freight. These all may adversely affect the company's results of operation. And the data are from its Monster's 10K report.
Now onto the acquirer. The acquirer that we've chosen is the Coca-Cola company. In 2021, net revenue of Coca-Cola company increased to $38.7 billion, a 70% increase from the previous year and 4% increase compared to pre-pandemic levels. Currently, Coca-Cola has a 19% stake in Monster, which was acquired in 2015. The Coca-Cola company has significant scale and geographic reach in more than 200 markets, which is leveraged from its extensive distribution network of their bottling system. Coca-Cola expects to continue exploring M&A and partnership opportunities to broaden and diversify its beverage portfolio. Past acquisitions include Body Armor in 2021 and Costa Limited in 2019.
And Coca-Cola company, next please. Yeah, Coca-Cola company has shown interest getting into the energy drink segment with Coca-Cola Energy in energy drink in January 2020, but has recently discontinued at the end of 2021 due to it not selling well. Currently, Coca-Cola company hold 19.3% of common shares in Monster Beverage, and with the full acquisitions, we believe that Coca-Cola is able to grow with the Monster brand instead of coming up with its new Coca-Cola energy drink. From the previous slide, we can see that Monster's future performance is substantially dependent on the success of its relationship with the Coca-Cola. And so with the acquisitions, Monster can eliminate this risk of being dependent on Coca-Cola, gaining full access to Coca-Cola's global distribution channel. And in terms of revenue strategy, Coca-Cola company will now have a strong energy drink and is able to enter a new alcohol beverage, the craft beer industry, and while increasing market share with the acquisitions. Also, the EPS accretion shown in the slide tend to be favorable to the company's market price in short term, at least. And besides the horizontal acquisitions, strategy provides significant cost redundancies from eliminating and leveraging Coca-Cola's existing infrastructure and overhead. More importantly, the economics of scale are able to help Monster to tackle the issue of rising cost of aluminum cans. Other synergies include increasing market shares of combined entity, complementary skill sets, headcount reduction, consolidation of overlapping facilities, geographical presence, and more.
Sorry, you're going to have to interject there. That's past your 8-minute time, but thank you very much for that presentation. Triple Monster. Judges, Danielle and Frederic, if you'd like to give your questions now. Thank you.
Yeah, could you go back to slide 15? And my big question there, I mean, I thought I saw that the EBITDA multiples were different to what you said Monster should be trading at, but maybe I read that wrong. Yes, isn't the average that you're getting up between 17 and 19? So why are you suggesting between 14 and 17? And in the table at the top, it shows for Monster Beverage Corp, it shows 17 and 19 times, doesn't it?
Okay, I think the 17 and 19 are the 2022 estimates. That's the 17.95, which you mentioned in our first slide. And the 19.75 is its current EBITDA in 2021.
Yeah, so my question is, why would it be valued at lower than that?
Actually, we are trying to be conservative for our whole analysis here. And all the analysis we used we will use the lower one compared to the higher one. Like for example, for the revenue and the percentage growth, we also consider the lower one. If we go
Yeah,
maybe.
but this is 2 to 3 turns lower than the market, and in the slides that follow, you say that it's still a 21 or whatever percent, a premium to market value. I mean, I haven't obviously looked at the math, but I don't see that math being correct then.
Sorry, which map is that again?
In one of the later slides, you say that you value, it whatever, and then you say that's 21 or 22% premium to market cap. This is after your football field. I think that's where you said that.
Oh, that 21% of premium of its current share price. Yeah, this one.
But that's
right?
my point, right? So if you're valuing it at lower than its current EV/EBITDA, then how can it be a premium to its share price? That logically does not make sense. I mean, maybe I'm missing something, but I doubt it. I think there's something wrong with the math. And anyway, it's not a big deal, but I just thought that seemed inconsistent. I do think that this is on merit looks like a good deal, so I'm going to give you that. Coca-Cola, where does Coca-Cola trade in terms of EV/EBITDA? Or let me put it another way. Do you think this deal is going to be accretive or dilutive for Coca-Cola?
Currently, Coca-Cola is traded at around it's
22 to 23.
Yeah.
So do you think that's going to make it accretive or dilutive for Coca-Cola?
Chun, do you want to share the accretion, EPS accretion slide?
So for the accretion part, we actually assume that it's 50-50 debt and equity financing with pre-tax synergy of 166 million. And currently EPS of the Coca-Cola is 2.95, and the target, which is Monster, have EPS of 3.5. So after the calculation we got, the EPS combo is about 3.02. So EPS accretion percentage about 2% here. And that's assuming 50-50 debt financing. So if we change it to 70-30, it's still going to be positive. But yeah, that's just a sweet spot there for 50-50.
That's fine. That's fine. Okay, that's all the questions for me.
And also, just to mention, the pre-tax synergy we have 166 is based on 3% of its net reported sales, which is again quite conservative here.
Okay.
We have about a minute left of questions, Frederic, if you'd like to ask something as well.
Yes, actually, just an observation, and it's also related to the valuation. I think you have your football field slide where you present the various methodology. I think that's a general comment, but you may want to have, perhaps a narrow range that basically helps you, basically have a valuation that is a little bit more precise, because I think right now I've seen multiples from 14 to 21, and then what happens in your football field, you can see clearly that the valuation methodology are quite, so I assume the current share price and and the valuation methodologies are quite not aligned. And although I understand that you're trying to be conservative, but if the company is listed, basically the valuation that you obtain from the various methodologies you have should be more or less in the same range. But you can see all that there's a lot of effort that went into the valuation process, and the idea is interesting. So yes, thank you for this presentation.
Thank you very much.
Yeah, thank you.
Great job, Team Monster. So now we'll move on to our penultimate team, the Preppers, if you guys would like to take the stage, or the boardroom in this case.
Okay, mic test. Karan, can you just tell us if you can hear me?
Yeah, I can hear you well.
Okay, could I get the screen share? Blake?
Got it.
Okay. All systems go. Good afternoon, judges and fellow competitors. I am Priyansh, and we are the Preppers. Today, we'll be taking you through a pitch for the acquisition of Haas Formula LLC by Andretti Autosport. Summarily, We'll discuss the industry, which we feel has a bullish outlook, Andretti Autosport Haas Formula LLC and their synergy, and how our acquisition thesis and projections show a 160.3% IRR. Thus, let's start with the industry. The way F1 teams make money is quite novel. Firstly, they have their own sponsorships, and secondly, they receive money from a prize pot, which comes from a portion of F1's total revenue. It's self-sourced from sponsorships, hosting fees, and broadcast revenue. As a result, F1 teams directly benefit from the growth of F1 as a whole. Furthermore, they benefit from performance, with stronger performance attracting bigger sponsors and bigger prizes. As shown in the table, appeal to markets such as the US and China also helps. We project that the sector will continue to grow based on strong growth right before the pandemic, a strong recovery, and increased appeal to the US market, among other factors. Now we'll talk about buyers. Andretti Autosport, our chosen buyer, largely operates in the US under the control of the legendary Andretti family. It is present in almost every form of racing other than F1. Their personnel are high profile and competent, and Andretti Group, along with Andretti Technologies, provide them with many opportunities for vertical integration. They do not have an F1 portfolio as of yet, but they have the funds to start due to a successful IPO, and they have shown interest in F1 lately. An alternative buyer we considered was Volkswagen AG. VAG has almost unlimited resources due to the fact that it is a massive corporation with huge revenue figures and owns marques with plenty of racing experience and expertise. But while that's all well and good, there is a major problem. Our identified seller proposition, which remains to be discussed, has no synergy with VAG as a buyer, since VAG has shown interest to enter F1 in 2026 under the new regulations and to do so with a championship caliber team, which disqualifies a 2022 deal with the Haas F1 team. For more on that, I'll pass my time to Ho Chang.
Hi, thanks Priyansh. Let's move on to targets. Haas is an ideal target due to its unique financial circumstances. Crucially, its lucrative title sponsorship from Russian corporation Uralkali was terminated in light of the war in Ukraine, leaving Haas with a funding hole. As shown here, Haas F1 is designed with an unconventional structure to minimize its expenditure. So, how has Haas been performing? Terrible. It was last place in 2021 and still struggling this season. This is because of two key reasons. One, Haas relies on their business partner Ferrari for critical engineering solutions. So it cannot outdo Ferrari for mechanical and business reasons. Also, the unusual structure of Haas means that they have to underspend compared to other teams, and hence they are likely to struggle in the future. In summary, Haas is incentivized to be acquired by Andretti, as Andretti's funds and engineering solutions are a much needed support that can alleviate their current weaknesses. And there are two potential alternative targets, Alfa Romeo and Scuderia AlphaTauri. They are similar to Haas as they are also F1 teams that have been underperforming lately on a relatively low budget. However, their respective owners are likely to have violent objections to acquisition attempts by Andretti, which makes them relatively less appealing. Now, my groupmates will discuss acquisition thesis and financials.
For revenue synergies, we believe that Andretti and Haas are the best companies to bring F1 to the American motorsports market. Not only are both companies American, Andretti in particular has strong brand recognition in the US, as well as strong candidates to debut the first American F1 driver since 2015. This will allow Andretti and Haas to capture a large proportion of F1 viewership in the US and gain lucrative American sponsorship money. This viewership will only be boosted by Haas's projected rise of the F1 standings, thanks to Andretti's ability to turbocharge Haas's car R&D. By itself, Haas has nowhere near enough funds to do so, especially since it is the smallest team, just lost its title sponsorship, and came in dead last. This is where Andretti comes in. With a recent IPO, not only would Andretti be able to fund Haas's R&D, Andretti also has strong industry partnerships that can provide bleeding-edge wind tunnel technology essential to constructing a competitive car. With these advances, Haas's standings and revenue will rise steadily over the coming years. In terms of cost synergies, acquiring allows Andretti to fulfill its F1 ambitions without entering a new team. This is important because entering a new team would incur a massive penalty of $200 million US, which will wipe out the amount raised in Andretti's recent IPO. Also, entering a new team will be detrimental to both Haas and the new Andretti team, since both teams are at great risk of coming in 11th. This is highly undesirable since the revenue for 11th place is a tiny fraction of the 10th place revenue, but this deal would avoid this scenario altogether. Secondly, Andretti's car-making expertise will allow Haas to bring car development in-house, which will mean Haas no longer needs to purchase the engine, gearbox, and aerodynamic parts from Ferrari, allowing Haas to greatly reduce its costs and finally step out of Ferrari's shadow. Now Zhe will cover the financials.
Thanks, Blade. Now let's take a look at the financials of the acquisition. Let's start with Haas. As Priyansh has mentioned, F1 teams has a different revenue model than typical companies. In particular, our projection for Haas's season standings over the years are important because that is the key determinant of its revenues. But we are confident in projecting that in 5 years, Haas can reach as high as 4th place because of the synergies generated by the financial support of Andretti. Our industry CAGR of 4.33% is also taken as a reasonable middle ground based on the past performance of F1 Group. Now we have the revenues for Haas. But Haas is a private company with its financials not found online. So how do we go about doing this? We effectively reconstructed Haas's financial statement using the financial ratios of 39 comparable sports teams. And the benefit of this method of projection is that our estimates will never be over-optimistic since it is always grounded in the performance of the rest of the industry. But we will later see that even with these conservative estimates, we can still achieve a high IRR. Now, we did the same with our buyer co Andretti as well. And with the financials of our buyer co and target co, we were then able to project the sources and users for this acquisition. Haas will cost about $344 million to acquire. To fork out this amount, we have carefully optimized the financial structure of the deal to make the acquisition as cheap as possible. We preferred cash than debt because of the increasing order of the cost of capital. It was a good thing that we did not have to tap into equity because of the dilutive impacts on the existing shareholder equity, notwithstanding its extremely high cost. In any case, we will later see that Andretti can easily service the $134 million of debt. Now we can construct the financials of our merger co, which we can see that the acquisition provides a very good 14% accretion average over 5 years, despite our conservative estimates. Our IRR calculation is effectively the value-added profit generated by the acquisition, which reveals 160% return. And finally, our model is not founded on wild and over-optimistic projections, as you can see on the sensitivity analysis below, covering the bear, base, and bull scenarios. We found that even in a bear case, we could reap an IRR of 143%. It is without a doubt that this deal is a win-win for both Haas and Andretti, and only value adds to all stakeholders involved. And now, finally, I'll pass the time to Blake to cover some of the risks that the deal could face.
For risk and mitigations, firstly, Andretti can provide the resources to fight the impending Uralkali lawsuit and keep it out of the spotlight. Secondly, should Andretti's American drivers be unable to perform well initially, the current Haas team can tide them over for the first few seasons. Thirdly, if the penetration of F1 into American motorsports is lower than expected, Andretti has extensive avenues in the US for cross-promoting Haas. Lastly, should Andretti's car-making expertise not translate well to F1, their partnership with McLaren can still provide great value to Haas. To conclude, this deal is ideal for achieving the strategic long-term goals of both Haas and Andretti and would herald in a new era of F1 in American motorsports. Thank you.
Thank you very much, guys. Right on the dot, 8 minutes. So judges, you will now have 5 minutes for any questions. Please take it away. Thank you.
Sure. Could you go to slide 20? Yeah, so I look at the F1 revenues and they seem to grow from 2.1, whatever that is, trillion to 2.6 trillion. And then I look at Haas's revenues and your projections go from 64 to 150. So that's almost triple. And that doesn't look conservative, nor does it look in line with the F1 group revenues. I mean, F1 group revenue, they're growing about, over the 4 years, about 20%, whereas Haas is growing 150%. That is not comparable by any measure.
Right, we can explain that. So if we go over to the, let's see, the slide appendix. Sorry, if we go over to the finance, slide 5, sorry, we can see that Haas's revenues is not directly projected or based on F1 revenues. It's also because it depends on Haas's competitive standing over the season. So of course, we have projected that Haas will go from 10th place all the way to 4th place, which means that the effective cut of the F1 revenue that is going to increase from 3% all the way until 5.67%. So yes, it won't be directly linear with the F1 group.
Elaborate on this point. Our predictions of performance are dependent on, of course, firstly, having this deal in place, because as we mentioned earlier, Haas is not in a position of having a lot of resources. So even though we can expect that they will perform at a midfield level, midfield being between fifth and seventh place at the moment, right now, as the season progresses, we can expect teams like Mercedes with much more budget and much more facilities and much better facilities and much better personnel than them to overtake them as time passes. And the same goes for many teams across the table. Anyone except for our two alternatives that we mentioned, Alfa Romeo and Alfa Tauri, can largely be expected to have the ability to overtake Haas, as happened in the last regulation cycle. So as a result, the way that we see this is that to prevent this fall and to allow Haas to really make the most of what is currently a strong performance in the first two rounds of the 2022 season, the injection from Andretti, as soon as it comes, sooner rather than later, would be the best way to ensure that Haas can rise up the rankings until fourth place. Now, we project fourth place because the top three teams, Red Bull, Ferrari, and Mercedes, are way overfunded and have extremely high-level talent compared to the rest of the field. And we don't expect that Haas will be able to unseat them in the short window of 5 years, even though a more long-term projection could be possible. So this is why we project that. And since we projected that, the revenue growth was therefore not linear with the revenue growth of F1 as a whole.
No, but Lene, I mean, you used the term conservative more times than I could count, and that's not. I mean, 150% or so growth is not conservative. Anyway, let's move to slide 21.
Based on, of course, the industry that we're looking at, right?
Actually,
conservative estimate is dependent on the performance. So when it comes to the performance that we are expecting, right, we have to expect the performance based on what we know about the technicals of the sport. And in this case, what I know about
Priyansh, I'm very conscious of that. We only have 5 minutes. Can we move to slide 22?
22.
Yeah. Transaction costs. Where does that 1% come from?
It is just a very general estimate. It is the M&A fee of the advisor. Yeah.
Right. Okay. So again, that again, coming back to your term conservative, that's not conservative. That's exceptionally aggressive. I mean, it should be more like 5%. But anyway, and then what have you assumed to be kind of your cost of debt?
Right. If we go over to slide 34, we can see our WACC calculation. It's all there. The cost of debt, we have taken the US prime lending rate because that is actually higher than what Andretti has right now, which is about 2-point-something%. So again, we have erred on the side of lower IRR here in taking 3.25%.
Okay, but no corporate can actually borrow at 3.25% at the prime rate, right? This is basically kind of for interbank and
that's right.
in prime market. So when you calculate the debt, and you've come to 14% or so, kind of accretion and all of that good stuff. What is the cost of debt that you use? Because I have a feeling that because you've used the cost of debt that's too low, your figures are looking too promising.
No, we use those numbers right here, and again, it's the actual debt we have projected for Andretti is even lower, which is about 2-point-something%. So we decided there's no way any company is going to secure 2-point-something% for its loan. So we just have to earn 3.25%. But even so, I would think that even if we increase it to say 5%, the IRR could still be around 90%. Yeah.
Okay. I don't have any more questions. Frederic, if you have any questions, I'll hand it over to you.
Yeah. So I just want to join Dan on the idea of a conservative approach. I mean, the more than 100% IRR and revenue doubling, tripling over next few years needs to be backed by stronger assumptions, and this is where it could be tricky, and this deal could not work because you may end up having different expectations between the buyer and the seller. And the way you present it might be from us perspective, where they believe they can achieve those type of revenues. If I were Andretti, I would say that I don't believe that this scenario is possible, but I'm still interested, and then I would negotiate the price or the valuation because the starting point I think that you're presenting here is not conservative, is probably way more on the high side. So that could be probably a deal breaker on the M&A transaction.
I think one thing that caused that result in our analysis is also the general nature of sport. in that sport is uncertain. And sporting wise, we have predicted a certain result that will result in quite a large revenue growth according to the chart that we had on slide 5. And while we have predicted this and while we feel that this is achievable and we have taken that as our assumption, I think that the negotiation for an actual deal between the two parties will depend on the assumptions of performance on both sides of the two parties. And this could be something that is, like you said, quite a big difference because it is very uncertain. And in a sport with only 10 teams, and out of the 10 teams, all of them are spending hundreds of millions of dollars and or pounds or whatever currency they're using on their facilities and on their drivers and on their performance to find tenths of a second. I think that it is really quite impossible to be totally certain, but the projections that we have made, and rather the pitch that we have made, is based on the projections that we have made and can be adjusted quite easily based on different projections that we can take into consideration.
Yeah, I do have one final appeal for these numbers. Let's go to slide number 6.
Guys, you're way over the time limit, so sorry about that. But great job and great dialogue towards the end. So great job, yeah. So now I'd like to pass it on to our final team, the wind energy team. And yeah, take it away. All the best.
Good afternoon, everyone. Can you hear us? Can you hear us?
Yeah, all good. Yeah.
Okay, thank you. I'm sorry. Okay, I'm gonna share the screen. Okay, here we are. Okay, Nicholas, you can go.
Hello, my name is Nicholas, and I had the pleasure of working on this project on the offshore wind industry with Jonah, Anselmo, and Farzan. So with that said, let's begin the presentation with the industry analysis. So globally, investments in the offshore wind space are forecasted to accumulate towards $810 billion by 2030, with Europe forecasted to consistently take on their majority share of 57%, regardless of the fast growth that the Asian market has seen in the past recent years. As shown here, the UK and Germany have been responsible for 75% of offshore wind capacity installations and a majority of investments. And also, as seen here, Europe will account for a majority share of net offshore installed capacity by 2035. And here we see the competitive landscape of the wind turbine market, which is considered to be the biggest segment of the offshore wind market. And essentially here we found that although there is little to mild concern of entrants or substitutes, the bargaining power of buyers and suppliers are a little bit more concerning. And we found that although the market is dominated by a few big players, they are all highly specialized in their industry and are willing to do whatever it takes to get that competitive advantage over their peers. Here, as mentioned before, the wind turbine manufacturing space is the largest segment of the offshore wind market. However, floating turbines are still in their earlier stages of development. And yeah, so even though the offshore wind market is responsible for only 0.3% of global energy production, the International Energy Agency have found that floating wind has the capacity to power the world 11 times over and have forecasted that offshore wind will become a $1 trillion industry by 2040. And here we found that Europe is still the most dominant and the fastest growing player in floating offshore wind. And here we found that the market is expected to grow rapidly and found that Italy has a positive outlook due to their optimal environmental conditions. Farzan, take it away.
Yeah, I'll be taking over from the growth drivers. We can see that the R&D investments in wind energy will be increasing from 18 billion to 32 billion over the next 5 years, with most of the countries pledging net zero aims at the Paris Climate Summit. Government policies are expected to favor investments, heavy investments in wind energy. Moving on to the SWOT analysis, the strengths. Not only does offshore wind have higher efficiency compared to solar, it also has lower carbon emissions per kilowatt hour of energy generated than solar. Floating wind specifically has a simpler deployment process because the floating platforms only need to be manufactured. Moving on to weaknesses, Offshore wind is susceptible to damage from high-speed winds, and these are expensive to repair. Floating specifically has high capital requirements because it is a nascent industry with no long-term data. Next up, we have opportunities. Higher wind speeds are experienced for offshore wind turbines, and these wind speeds are witnessed regularly. The Russia-Ukraine war has attracted great investments towards renewables because of cutting dependence on Russian oil. The EU market with net zero aims again provides first mover advantages. Deep offshore areas where fixed turbines cannot be possible represent 80% of European offshore wind potential. Next up, we have threats. The industry faces raw material supply chain issues. The Russia-Ukraine war has led to a temporary delay in projects due to immediate energy requirements of countries and also created supply chain bottlenecks. The business opportunities arising from potential wind projects in the Black Sea also have a bleak future now. Floating specifically, being at a nascent stage, has a lack of skilled manpower. Jonah, you'll be taking over.
Oh, no, I'm going to take on to the potential buyers. Here we see Acciona, which is a Spanish-based company operating in the infrastructure and energy industry, which, however, bought a 30% stake in Nordex SE, which is a wind energy production company. It has a great geographic reach and an almost 12 billion market capitalization with a strong cash and cash equivalents and a positive free cash flow from 2021. Then we have ERG Evolving Energies as our second potential buyer. It was an oil refining company born in Italy, however now operates with its division ERG Renew in the offshore wind energy industry, and it's the greatest player in Italy. And has expanded into France, Germany, and recently also into Sweden. Here we see a 5 billion market cap and steady positive free cash flows during past years. The last potential buyer is Vestas, which is a Denmark-based company. It's the leader of the offshore wind energy production industry. However, having a great M&A activity, a flourishing M&A activity, it may not be interested in the potential sellers we are going to present right now. However, we decided to consider it as well. Jonah?
Thank you, Anselmo. Let's talk about Blue Water, the first firm. It's a private company with headquarters in Netherlands and has a project in floating wind turbines platform. And the problem is that it mainly operates in the oil and gas services and equipment. Since it's a private company, we decided to use the comparable company analysis. And on the left-hand side, we can see the peers. On the right-hand side, the metrics and the enterprise value that we estimated for this target firm is $1.7 billion. Since, as I said before, is a private company, now we will talk about company valuation of listed companies. That will be the next two firms that we will see. We decided to apply. We decided to talk about Hexicon first. That is went public in 2021. Is a stock in a Stockholm Stock Exchange, and core business and the core technology behind this firm is Twin Wind. That is a dual turbine floating wind power platforms. The valuation is just an application of the premium price over the last price traded, that was $0.24, and we found a tender offer of $1,030 million. Last but not least will be Byview Ideal, and in this case again we have a core technology that is damping pole that optimizes stability and performance of floating wind turbines in extreme weather conditions, and is a Norway firm. We found the valuation for this firm, and the tender offer is 84.79 million. Now it's up to Anselmo.
Yeah, now for the optimal deal, we decided to go for ERG Evolving Energies and Hexicon, having many benefits both on the side of ERG, especially diversification, by entering the floating offshore wind market, and the acquisition of a license for the twin wind technology, which can be introduced into Italy, and this can benefit also Hexicon with revenue enhancements and cost reductions thanks to the efficient supply chain and the know-how rollout of ERG. The deal, we decided to structure it as an $88 million. I'm sorry, okay, just finish. Is an $88 million upfront payment with earnout payments during the 3 following years. Thank you very much, and on with the questions.
Okay, yeah, thank you guys. Judges, please feel free.
Did we look at the valuation? I'm sorry, I might have missed that.
Yeah, okay, for sure. For which company? I'm sorry.
The Optimal Solutions only.
Okay, sure. Hexicon. Yeah, here it is. Here it is.
And what are you saying is the acquisition price of the market cap is 88 billion?
Oh, the market cap is 88.6 million. And then the tender offer would be 130 and 113.5 millions based on a 30% premium on the last observed share price. We decided to go for a 30%, even if the average is about 43%. But as you may have seen in the last slide, we actually structured an earnout payment, which goes from a 30% to a 50% premium. The problem with this company, as Jonah said, is that being IPO'd last year, we obviously had a little bit of difficulties in finding the data to produce a DCF with expected cash flows, and so that's why we decided to go for the current market valuation in order to determine the tender offer from ERG.
But are there no research reports or anything showing kind of enough information to do a DCF? How do analysts value this?
Well, this is a fairly innovative company because we're talking about the floating wind energy production industry, which is actually still undergoing many regulatory issues. Not issues, but it's going to break through during the following years. So probably there is no history, and so that's why we had to base our valuation not on forecasts of free cash flows, but on the current market capitalization. In fact, as you can see in our last slide, we had to propose quite a conservative deal because of the fact just the market capitalization itself as a base. And then, if the company was able to reach, for example, a positive EBITDA, because it doesn't have a positive EBITDA at the time, but has a great opportunity of growth thanks to its twin wind technology, which is way more efficient than fixed offshore and then single turbine floating offshore wind production, may actually happen during the following years. We decided to go for a 30% premium, and then
I'm conscious of time, so I'll interject. But you said 3 earnout payments reaching 50% premium, which you just talked about. Why? Yeah. Why would you? I mean, other than the fact that it's a nice thing to do, why would you propose that? Because it's nice.
The earnout itself.
Yeah, the earnout itself. Exactly. Yeah, and when you say, sorry, let me complete the question. When you say
for sure.
Regulatory milestone, what exactly do you mean?
Oh, by regulatory milestone. Well, it's written here. The fact is that floating offshore, but in general offshore wind production energy has to be is highly regulated, and it has to be accepted by governments for its development. In fact, if ERG, which is an Italian company, would buy Hexicon, the Italian government would have to give its permission, let's say, to the Hexicon company to introduce the twin wind technology to the Italian market and to start actually developing floating platforms to install this twin wind technology and start producing energy. So that's why we thought it was very important to set such such a milestone to be reached in order for this kind of payments to go through. Otherwise, well, it may take a longer time. We decided to set 2027 a five-year horizon for this authorization, because obviously it's not happening in a few
times. If that regulatory milestone, as you call it, does not get achieved, then this transaction basically kind of achieves nothing, right? Because obviously then you can't.
Well, we base the assumption is that the floating wind energy production is already undergoing in Italy and in many European countries. So we obviously thought about the potential of a company which is probably going to get their authorization. What we said is that the milestone, the earnout, so the additional almost $9 million would be earned by Hexicon shareholders only if the authorization is to start installing floating wind turbines before 2027. It's not a problem of actual obtaining of the authorization, because obviously if we're talking about the European market, which is highly integrated, if the authorization as went through in Sweden and other countries in the north of Europe, since our Hexicon company is Swedish, it is probably going to go through in Italy as well because of the EU regulation, current EU regulation.
And to add on to that, it also has projects in France and Japan as well.
Sorry, Farzan, I'm going to have to interject there. I already gave you about a minute extra, but that was great dialogue. So sorry, Frederic, I apologize. We weren't able to get to you, but maybe you can give your thoughts. No worries, no worries. So now myself, Jalil, and the judges will get into a breakout room and decide the verdict for third, second, and first place. So great job overall, guys. We'll see you soon.
Thank you.
Hello, everybody. So we're back. There were some tough decisions made, but we have a verdict. Jalil, I'll hand it over to you to announce the winners. But yeah, I just wanted to say overall, great job, guys. Every presentation was very, very informative, very well researched, and it was certainly very, very helpful for all of us to see all the hard work you've been putting over the week. So great job, everybody. Jalil, I'll hand it over to you.
Thank you so much, Karan. Definitely, we can clearly see all the work that has gone into each of these presentations, all very deserving to be here. And you know, it's very impressive what they've accomplished in the last 8 weeks, especially because I feel like, you know, 8 weeks is quite a short period to conduct all this research, do all this analysis, but also you know, come up with an optimal deal. I was wondering if Frédéric and Daniel, if you guys wanted to give just some general thoughts on the presentation just before we announce the winners, and then I'll go ahead and give the positions for third, second, and first.
Yes,
sure.
So if it's okay, I can go ahead first then. Okay.
Yep.
So so yes, thank you all for this presentation. I think as a general comment, it's very good to get used to, you know, present and being able to deliver those messages in this kind of format. My own recommendation would be to always make it simple and straight to the point. And in general, for your presentation, we've seen it in a few presentations tonight. Each slide should have a key message, and basically there should be a continuity throughout the presentation. So we've seen, we heard in terms of the content, we've heard about interesting sectors, interesting proposals for transactions, so great ideas, and again, thank you for having us as judges, and all the best. You can go ahead.
Yeah, I mean, I echo all of what Frédéric said. Look, all of the presentations were very good. A lot of them showed a lot of understanding of, you know, the deals that you were talking about. I mean, I remember my analyst days, and you know, some of these things were not that clear to me back then, but they have obviously over my career become clearer. A lot of you showed a lot of kind of, you know, understanding and you know, profound knowledge of the subject that you were talking about. So well done. Everybody should be very proud. Without exception, found all of the presentations to have good content, well researched, well presented, you know, put together, hitting all of the right spots. It was not an easy decision to judge. We did have to obviously ask some questions and then, you know, pick winners based on your presentation and your understanding, and you know, all of the 6 or 7 criteria. But look, I mean, everybody's a winner, and you know, the numbers that will be assigned to, you know, first, second, and third are, you know, at the end of the day arbitrary, because you know, you should all be proud for what you've achieved and where you've reached, you know, over the last 8 weeks.
Okay, well, thank you so much, Frédéric and Daniel, for your comments. I think that the participants definitely got so much out of your questioning, and I thought it was really interesting. I spoke with Daniel in the breakout room just specifically about a few presentations, and I really enjoyed the how he approached them. So without further ado, it is time to announce our winners. So first, in third place, we have Stamford Capital. Congratulations. If you will, Daniel and Frédéric, do you guys have maybe quick 1 or 2 sentences about this presentation?
Hi, thank you so much to the organizers, the team, as well as the judges. Thank you for taking the time to review our presentation and giving us remarks as well. Yeah, thank you so much.
Yeah, look, I thought it was a well-researched presentation, well put together. You hit all of the right areas. The origination was spot on, and you know, kind of your conclusions I did agree with. The only things that I would kind of work on a little bit were on the mechanics of the actual transaction and some of the numbers behind it. But other than that, I thought this presentation was spot on.
Okay, sure. Yeah, thank you so much. Thank you so much for the feedback.
Yeah, just to same comment as Dan, well presented. I like the how you conducted your analysis, and yes, in terms of the valuation, yeah, that requires a little bit of work, but it was well executed and well thought. Thank you.
Okay, perfect. Well, now going on to our second place finalists, we have McGillions. Congratulations, McGillions. If you have maybe a few words like Stamford Capital, and maybe a few words from the judges as well.
Absolutely, it was a pleasure to present. It was very nice to see that Daniel, you carried out the IPO for Finavler, so that was a surprise, let's say. So in the questioning period, that was interesting. But yeah, it was a pleasure to present and to see all of the presentations, and I look forward to maybe participating next year.
No, thank you. And look, I mean, the subject matter obviously very close to my my past life, if not heart. Then I mean, I've spent a lot of time kind of doing work on all of this. Moneycorp used to be a close client of mine when they used to be owned by Corsair. So obviously know the sector very well. I think you guys did a good job in understanding the sector and also putting together the transaction. Knowing the sector well, obviously, I think I can tell you that from a practicality perspective, it's not a very good deal. But your thought process was right. Kudos to that.
Mm-hmm. All right. Well, Frédéric, if you
yes, I mean, just briefly, well done. Very good understanding of the market. There was a lot of information that was shared, and very interesting way of putting this proposed transaction. So well done.
Okay, perfect. So now on to our first place winners. We have, drum roll please, Triple Monster. Congratulations on your first place finish. If you guys will have a few words for the judges and for the rest of the participants.
Thank you very much. Thank you very much for the award, and I really appreciate it for the judges' time, and we're actually quite curious about like what are the improvements that we can have as well. Yeah. So yeah, thanks again for the organizer and the judges.
Look, your presentation was very well put together and well presented as well. I couldn't fault it for kind of the thought process and the presentation itself. Because you've asked for areas of improvement, the only thing that I could see you could work a little bit more on is the numbers. Having said that, I don't think from kind of the level that you're producing this presentation, there is anything to be kind of wished for. I mean, I think it was good on all fronts, and we've rated it as such. But yeah, simply to answer your question, the numbers obviously still could use some work. But well put together, good idea, well presented. I think it's something that we could see happening in the real world. So well done.
Yeah, it's a great Dan. I think it's a transaction that could definitely happen in the coming years, and it was well presented. In terms of the valuations, I think I was not expecting so much details, to be honest. You guys honestly put a lot of work on it, on the analysis stuff, etc. So very well done. And in terms of areas of improvement, I mean, it's investment banking, M&A, or rigorous and demanding jobs. So So you can always improve, you can always do better. So don't worry. When you get there, you will find a million ways to improve it. But for today, honestly, it was great. So thank you.
All right.
Actually,
perfect.
Sorry, on that note, one thing that I can think about is you guys had way too many decimal points. 1 decimal point is more than enough. Or decimal places after decimal points.
Okay, yeah. Thank you.
Fair enough. Well, perfect. Well, I feel like this marks the close of the Spring 22 Close the Deal competition. I want to thank all the participants again for their time to come to the finals, and also for all the work that they've put in. Obviously, as we can see from these presentations in the last 8 weeks. And I hope that you guys all can really see the level at which all of you are producing, obviously, like Dan and Frédéric were talking about. And thank you all for coming, and that is all.
Thank you so much, everybody. And especially thank you, Dan and Frédéric. It was really great to hear your input. Well done, everybody. See you next semester.